In the last 24 to 48 hours, Japan's rate story got louder, not from a surprise decision, but from a very clear message. A Bank of Japan board member argued that further rate hikes should continue to finish normalizing policy, with inflation still running above 2%, and the weak yen feeding prices. Here's the promise. By the end, you will know why a few sentences from the BOJ can move the yen, nudge global yields, and quietly change what risk looks like in credit and equities. And you'll have 3 clean signals to watch this week. Start with what actually happened. On Friday, February 6th, a BOJ board member, Kazuyuki Masu, told business leaders that rate hikes need to happen in a timely and measured way to keep underlying inflation from drifting above target. In the same window, Japan's public debate shifted toward the same idea from a different angle. A former top FX official argued that intervention works best when it is backed by a rate path that markets believe. 2 messages, same pressure point. Japan is no longer the world's easy funding valve. It is trying to become normal again, and the market has to decide how fast that normal arrives. Now, the anchor example, because this story can feel abstract. Picture a global macro fund that has lived off one simple habit for years: borrow in yen at very low rates, convert to dollars, and buy higher yielding stuff. U.S. Treasuries, investment-grade credit, maybe a basket of carry currencies. That trade is not a meme, it is plumbing. It is how cheap funding turns into global risk appetite. When the BOJ hints that cheap yen is getting less cheap, that entire habit starts to wobble. In plain terms, this is about the world's cheapest borrowing currency getting more expensive. Now, we build the mechanism step by step. Step 1 is expectations. Policy moves markets less than policy paths. If the BOJ sounds more willing to hike again, traders pull forward the timing of the next hike. Even if the next meeting is a hold, the curve can still reprice. Front-end Japanese rates move first. Step 2 is the yen. A currency is not just a flag. It is a price for money across borders. If Japan's rate path shifts up, the gap between Japanese yields and foreign yields narrows, even a little. That reduces the reward for being short yen. Step 3 is positioning. The yen has been a common funding leg for global trades. When the yen starts rising, or even when it becomes jumpy, funds reduce exposure. They hedge. They cut leverage. That can force selling in the assets they bought with borrowed yen. Step 4 is spillover. That selling pressure can show up as higher global yields, wider credit spreads, and more equity volatility. Not always all at once, but the linkage is real. Put simply, a Japan rate story can become a global risk story. So, what did markets do around this? FX is usually the first scoreboard. USD versus JPY becomes a referendum on whether markets believe Japan's path is shifting. If the yen strengthens, carry trades feel pain. If the yen keeps weakening, officials start talking more loudly about intervention. Either way, volatility can rise because the policy signal is now contested. Rates are the second scoreboard. Japanese government bonds can sell off at the front end when hikes feel closer. U.S. yields can react too, not because America changed, but because global portfolios are linked. Japan is a huge pool of capital. When hedging costs change and rate differentials shift, flows shift. Credit is the quieter scoreboard. If carry is being reduced, the first place you often see it is not a headline index. It is spreads that stop tightening. It is funding that gets a touch less friendly. It is refinancing that becomes a bit more expensive at the margin. Equities are the emotional scoreboard. Japan's equity market can like higher rates if it signals real growth and wage power, or it can hate higher rates if it means a stronger yen hurts exporters, and global risk gets less liquid. That's why this is not a one-line story. Here's a receipt moment you can show on screen. In the BOJ speech, there is a direct line that says, continuing further rate hikes will be needed to complete normalization. That's not a rumor, that's a policymaker telling you the direction of travel. And a second receipt moment sits right next to it. The same speech notes that CPI has been above 2% recently, with a December reading around 2.1%. That matters because it frames hikes as a response to inflation persistence, not a random hawkish flex. Now, the part people misread number 1 is, Japan already hiked, so this is done. Japan's policy rate being above zero does not mean policy is tight. What matters is the gap between the policy rate and neutral and what inflation is doing. If inflation is above 2% and the policy rate is still below a reasonable neutral range, policy can still be accommodative. That is why a gradual hiking path is still on the table. In plain terms, not negative is not the same as tight. Misread number 2 is, if the yen gets ugly, they'll just intervene and fix it. Intervention can change the tape in the moment. It can scare speculators. But if the underlying rate gap stays wide, the yen often slides again after the splash. That's why you saw the argument that intervention needs a credible hiking path behind it. Now bring back our anchor fund, because this is where it turns from policy talk into positioning. If you are that fund-borrowing yen, your profit is the yield pickup minus hedging and volatility. A more hawkish BOJ can hit you 3 ways. The yen can strengthen, which hurts your unhedged position. The cost to hedge can rise. And implied volatility can rise, which raises the risk cost of staying in the trade. So you de-risk. You trim the dollar assets you bought. You reduce leverage. You stop being an invisible buyer of duration and credit. That is the quiet, what could break next angle. It is not Japan exploding. It is global carry getting less comfortable. So, what should you watch next? In the next 24 to 72 hours, the market is going to keep stress testing the words. Every speech, every leak, every inflation print, and every yen move becomes a mini vote on the path. In the next 2 to 6 weeks, you get the bigger catalysts, wage negotiations, inflation components that matter for underlying trends, and meeting-to-meeting guidance that tells you whether this is one hawk talking or an institution shifting. If this persists for months, the story gets structural. Japan stops being the default funding source. Global portfolios have to reprice the cost of money. Now, lock in the 3 signals, because these are the clean ones. Signal 1 is USDJPY, but not just the level. Watch whether moves are orderly or jumpy. Disorderly moves often pull officials into the conversation, and that can change volatility fast. Signal 2 is front-end Japan rates pricing. Watch the market's implied odds of the next hike, and how the 2-year JGB yield behaves around BOJ communication. That tells you whether timely hikes is becoming consensus. Signal 3 is the inflation persistence proxy inside Japan, especially processed food inflation and wage momentum. If those stay firm, the BOJ has cover to keep tightening. If they roll over, the tone can soften. That's the setup. Next, we connect the yen story to U.S. yields, credit spreads, and the trade that sits underneath global risk. Now connect the yen story to the rest of the board, because this is where people underestimate Japan. Japan is not just a country with its own bond market. It is a global duration holder. It is a major hedger. And it is one of the biggest sources of cheap funding that has powered cross-border risk-taking. When that changes, it does not always show up as a huge headline move. It often shows up as a slow shift in demand. Start with U.S. yields. If Japanese investors reduce purchases of U.S. treasuries, or if they keep buying but hedge more aggressively, the marginal buyer becomes more price-sensitive. That usually means higher yields, or at least less downward pressure on yields. It can also mean weaker auction demand at the long end when supply is heavy. In plain terms, fewer eager buyers means yields need to do more work. You can see this in a simple chain. BOJ hawkish tone pushes up JGB yields. Higher JGB yields improve the home alternative. At the same time, if the yen strengthens or becomes volatile, hedging costs and risk costs rise. That makes U.S. treasuries less attractive on a hedged basis. The result is less foreign demand at the margin. Now, blend in the second channel, the carry trade itself. Carry is not just about buying bonds. It is about using cheap funding to hold a basket of risk, credit, equities, emerging market FX, commodity exposures. When the funding leg moves against you or volatility jumps, you cut the whole basket. That is why the yen can lead global risk off. Here is the key idea. When risk sells off, people look at equities and assume equities caused it. In many episodes, the real first domino is funding. If funding tightens, the selling starts because positions get smaller. That brings us to credit. Credit spreads are the most honest way to see whether the market believes the funding environment is getting worse. Not just in Japan, but globally. If the yen is strengthening and the BOJ is signaling hikes, watch whether investment-grade spreads stop tightening. Watch whether high yield spreads widen. It can be subtle. It can lag by a few sessions. But credit is the channel where carry discomfort becomes measurable. In plain terms, credit is where risk turns into a bill. Now, equities. A stronger yen can be a headwind for Japanese exporters because it lowers foreign earnings when translated back. It can also change global equity leadership. If the yen strengthens and U.S. yields rise at the same time, the discount rate pressure hits growth stocks first. If credit spreads widen, cyclicals follow. So, the Japan story can morph into a multiple compression story, even without new U.S. data. Now, bring back the anchor fund again. We need to evolve the example, not repeat it. In the first block, the fund was borrowing yen and buying treasuries and credit. Now, imagine the fund faces a simple choice after that BOJ speech. Do they keep the trade and accept more yen risk, or do they hedge more? If they hedge more, they buy options or forwards. That pushes up implied volatility and raises hedging costs. Those costs reduce expected returns. Lower expected returns means they cut size. If they do not hedge more, they take spot risk. If the yen strengthens quickly, they can get forced to cut anyway. That forced cut is worse because it is not planned. Either path points to the same outcome, smaller positions. That is the what breaks first pressure point. It is not the BOJ's credibility. It is the size of leverage positions that assume the yen would stay cheap and quiet. Now, layer in the political and intervention angle, because it is part of the volatility story. A former Japanese currency official said intervention should be backed by rate hikes. That line is important because it tells you what officials think markets will respect. They want a policy mix that makes sense, not just a one-off defense of a level. That means if USDJPY weakens the yen quickly, the likely response is not just words. It is a blend of words and a rate path signal, or at least an attempt to appear consistent. In plain terms, they want the market to believe the story. Now, how do we make this story testable with receipts, not vibes? Receipt moment number 1 was the BOJ normalization line. Receipt moment number 2 is the inflation print cited, roughly 2.1% in December. It is a number that anchors the reason for hikes. Now, add a third proof shot you can show on screen without over-precision. Japan's banks themselves have been reported as ready to increase JGB holdings as yields rise. That matters because it is a domestic bid that strengthens the home alternative. When the home alternative strengthens, foreign allocation is not as sticky. So the story is not only BOJ words, it is BOJ words plus domestic behavior. Now we apply the stakes ladder, but in narrative form. Over the next 24 to 72 hours, the highest risk is volatility, not direction. A single sharp yen move can force risk reduction. The market can overshoot, then reverse. That whipsaw is what kills carry trades, not the slow drift. Over the next 2 to 6 weeks, the focus shifts to confirmation, wage momentum, inflation components, and BOJ communication consistency. If you get a pattern of similar messages from multiple officials, the curve will start treating hikes as a base case, not a tail. If this persists for months, the global implications become larger. Japanese capital becomes more domestically focused. The yen becomes less reliable as a funding currency. And global markets lose a structural source of cheap leverage. That is not an apocalypse, but it is a regime shift in how risk is priced. In plain terms, the world gets a little less free money. Now, quick objection crusher, because this is where smart viewers push back. The first objection is, but if Japan hikes, won't that crush Japan's economy and force them to stop? The answer is that the BOJ is explicitly talking about a timely and measured pace. They are trying to avoid shock. If inflation stays above target and wages support demand, a gradual path can be sustainable. The real break is not the hike itself. It is whether financial conditions tighten too fast. The second objection is, but the U.S. still has higher yields, so why would Japan flows matter? Because marginal flows matter at the margin. The U.S. Treasury market is huge, but it is also constantly refinancing and issuing. If the marginal foreign bid is less eager, yields can still drift higher, or auctions can clear with slightly worse pricing. That matters for mortgages, corporate borrowing, and equity multiples. Now, we finish this block by tightening the 3 signals into exact where-to-look instructions. Signal 1, USDJPY. Look at whether the move is orderly. If it starts moving in large intraday ranges, that is a stress tell. And if officials start pushing back in headlines, volatility can jump within hours. Signal 2. Japan's front end. Look at the 2-year JGB yield behavior after BOJ comments. If it keeps ratcheting up on speeches, the market is buying the path. If it fades quickly, the market is calling it talk. Signal 3. Japan's inflation persistence. Look at processed food inflation and wage indicators. If those stay firm, the BOJ has political and technical cover to keep tightening. If they roll over, the normalization narrative weakens. Next, we close the loop with what this means for a viewer in the real economy, and we land the recap. Now translate this into real-world consequences, because a lot of macro videos stop at yen moved, and that is not useful. If Japan's rate path is rising and the yen is less stable as a funding currency, the cost of capital can drift up globally even without a new U.S. shock. That can show up as slightly higher mortgage rates, slightly higher corporate borrowing costs, and more sensitivity in equity prices to any earnings disappointment. In plain English, when cheap funding gets less cheap, everything financed by borrowing gets a bit more fragile. Bring back the anchor example one last time. That global macro fund does not care about Japan for patriotic reasons. It cares because Japan sets the funding conditions for parts of global risk. If the fund can borrow at near zero and the yen stays calm, it can hold more risk. If borrowing costs rise and the yen gets jumpy, it holds less risk. That is why a speech can matter. Now, because this is Risk and Recap, we end with the clean what to watch next, and we keep it newsroom calm. Here is the pressure point, stated clearly. The first thing that breaks is not Japan's economy. It is the leverage built on the assumption that yen funding stays cheap and quiet. If that assumption fails, you get quick de-risking. And you see it across multiple assets, even if the headlines sound local. So, what could move this story in the next week? If you get another BOJ official reinforcing the same message, markets will treat it as institution level. That can strengthen the yen and push Japanese yields higher. If you get a softer inflation read or weaker wage signals, the message can fade. That can weaken the yen again and bring the intervention narrative back. If you get a sharp yen move either direction, volatility becomes the story. Volatility is what forces position changes. Now the three signals again, tight and practical. Signal 1, USD/JPY price action and intraday range. Where to look is any standard FX chart, plus headline feeds for Japanese official comments. Direction that matters is a strengthening yen or a widening daily range. Typical lag is immediate for risk sentiment, and 1 to 3 sessions for credit spreads. Signal 2, Japan's front end, especially the 2-year JGB yield and implied pricing for the next hike. Where to look is JGB yield curves and short rate futures. Direction that matters is a steady ratchet higher after speeches. Typical lag is same day for FX, and 2 to 5 sessions for global rates spillover. Signal 3, Japan's inflation persistence, especially processed food inflation and wage momentum proxies. Where to look is Japan's CPI detail and wage releases. Direction that matters is whether inflation stays above target in the sticky categories. Typical lag is weeks, but it sets the policy path. Now a final recap, because the point is clarity, not noise. What happened was simple. A BOJ board member signaled that further rate hikes should continue to complete normalization, citing inflation staying above 2%. At the same time, a former top FX official made the intervention message explicit. If you want a durable yen defense, it has to be backed by a credible rate path. Why it happened is also simple. Japan's inflation is still too firm to declare victory. The BOJ is trying to prevent underlying inflation from drifting higher without shocking the economy. Why it matters is bigger than Japan. The yen has been a common funding currency. If it strengthens or if volatility rises, global carry trades can shrink. That can lift yields, pressure credit, and raise equity volatility. What to watch next is those 3 signals: USD/JPY behavior, the Japan front end, and inflation persistence. That's the risk, and that's the recap. If you want the clean signal check, look at those 3 markers this week. I'll see you in the next one.